We are back. Welcome back. We are live at the Context Leadership Summit here in Las Vegas today. Job openings in the United States hit a record 6.6 million in March, according to the Labor Department. The JOLTS number came out yesterday, but hiring fell to 5.4 million, suggesting that companies are not finding the skilled workers for the positions available. Last week, I spoke with Treasury Secretary Steven Mnuchin, where he brushed off concerns about a tightening labor market. Here's what he said. What do you say to managers when they say, and I'm sure you've heard it, I've heard it a lot, I can't find the people to put in the jobs that I have available? Is that about training?
I think some of it is training, but I'm not hearing that from the companies I speak to.
Joining me right now to talk more about that is the senior economist with Deutsche Bank, Brett Ryan. Brett, good to see you.
Great, thank you.
What's your take on the labor market today?
We think the labor market's fantastic. You hit 3.9% on the unemployment rate. That's the lowest level since December of 2000. And you're hearing many anecdotes within the Fed's Beige Book and other sources of tightness, especially in skilled labor areas and also in things such as truck driving, construction. They're having hard times finding workers, and you're seeing wages start to creep up a bit.
So when you say the labor market is fantastic, it's tight, is what you're saying?
Yeah.
It's very tight. Were you surprised that Steven Mnuchin hadn't heard that?
Yeah, that was a little bit surprising. I'm not sure the context that he was referring to. I mean, this is.
But you say even industries like truck driving. What's going on with truck drivers?
Yeah, you're seeing them offering bonuses to lure drivers over. You're seeing states even offering bonuses to lure people to move to their states for jobs. And those are the types of signing bonuses. When you start seeing that, oil companies in the oil patch, and the energy is recovered. And you're seeing those sorts of things, and you're seeing the hiring rate and the quits rate both at elevated levels back to the pre-recession peaks. That's a solid sign for the economy.
What does this mean for the Federal Reserve in your view? It
means the Fed keeps going. So from our standpoint, we think the Fed's going to go 3 more times this year.
3 more, so that's a total of 4 this year.
Total of 4
Does
this year.
that worry, though, you that perhaps they could overdo it? Because we talk a lot on this program about the weakness in the consumer, that perhaps the consumer is saving the savings that they got from the tax plan as opposed to spending it.
So the consumer's doing pretty well. When you look at the income generation from the labor market, and we take jobs, hours, and wages, consumer is very well supported at this point. First quarter was a little weak, but that's to be expected because you had some weather-related issues in the previous quarter, and it's the first quarter. This has had some residual seasonality problems for a number of years. So I'm fine with where the consumer is right now. In terms of the Fed, I think I'm okay with them getting to neutral. So right now, given where we are in rates, the Fed funds effective is 170. 3 more rate hikes is not really going to slow the economy. In fact, they're still going to be accommodative up until they get to about 2.9% in their forecast. In their forecast, the rate of interest at which it's neither pushing against the economy or aiding the economy is 2.9%. So we still have a ways to go before we get there.
Right. So this is pretty bullish over here in Vegas, Dagan, and we know that we've heard from some of our guests, including Stephanie Pomboy, including the president of the Dallas Federal Reserve. A lot of people say it's the Federal Reserve that's the risk here. They could overdo it.
They could overdo it, but one thing that we talked about at the start of the show, and if we can show it, because we talk about the concern about rising oil prices, the impact on the consumer. Are consumers strapped with debt? They're saving money, not spending it. But if you look at oil, so it's above $70 a barrel, but if you look at the 10-year Treasury, that yield was back above 3%. Again, if people were worried about the economy going into the tank and worried about the Fed overdoing it, at least this morning, they would be buying Treasuries, not selling them, and you wouldn't see that yield back over the 3% mark. So again, there's a lot of optimism, and certainly in these jobs numbers that we got, the job openings and the people who are unemployed, you get restaurant workers are looking, restaurants are looking for workers because people are moving on to better jobs. Unemployment among low-skilled workers is at a historic low. Really incredible.
Your thoughts?
Yeah, that's exactly right. And you do have a point that the Fed has to be careful overdoing it,
especially in the face of the debt. President Trump is calling on Congress to pull back spending right now because we're talking about trillion-dollar deficits. He wants to pull back $15 billion in spending as the budget deficit is up to $1 trillion.
So when we're talking about pulling back $15 billion in spending, The federal government spends $13 billion every day. The federal government spent $27 billion on Medicare on last Tuesday alone. So, when I hear things like that, that's really kind of drops in the bucket. The debt is a problem if productivity growth doesn't come back over the long term. And what it does is it crowds out other investment over time. It's not a near-term concern. It's not necessarily a dollar concern at the moment.
Okay.
There's not a solvency issue. We are the reserve currency. In fact, people want a supply of treasuries.
Right.
We've been lacking a little bit of supply of treasuries, arguably, in some sense. So it's not necessarily an issue now. It's what are we setting up for down the road? And one complaint against the recent stimulus measures with tax cuts and spending has been it creates a little bit of an artificial cliff in 2020. So
2020, you expect things to start slowing down.
Right. The fiscal impulse starts to fade.
I see.
And so the risk of the Fed overdoing it is that this makes the Fed's job a little bit more difficult because they can't gauge the underlying trend in the economy.
Sure.
And if they do end up overdoing it and then growth slows as we get that fiscal cliff, that's where your risk of recession starts to rise.
All right, we will watch that. Brett, good to see you.
Great.
Thanks so much for joining us this morning. Brett Ryan from Deutsche Bank.